Hello, this is John Burford, Money Week Trader, and this is my trade for 2012. Apologies for not mentioning it at the workshop. There just wasn't enough time. But I'm sending you this video as I can give it a little more coverage, I feel, in this format. Now, why am I looking at the US dollar against the yen? That's my trade for 2012. Well, for one thing, it's been in a massive bear market. As you see here, the exchange rate was roughly 125 at the peak in 2007, and along with the credit crunch, the value has plummeted as many factors involved, of course, but one of them is the carry trade. A lot of the hedge funds are using that. I'll discuss that in just a moment. But in any case, we've had a rapid fall in the value of the dollar against the yen, with these huge counter-trend rallies. Of course, you must expect those in any very long-term trend. But I think here we've reached, I feel, a bottom. I think that's a pretty fair estimate of where we are, and I think we're coming off the bottom now. So this could be the early stages of a very big rally, multi-year, in much the same way as the bear market was from 2007. We could see a very nice multi-year, certainly multi-month bull market. Okay, now the yen, it has been strong since 2007, and on the face of it, it's pretty puzzling because interest rates in Japan have been at rock bottom for a very long time. The Japanese budget deficit, although it's huge, has been financed mainly by the domestic residents who prefer to save with the post office. Now, the post office loyally purchase Japanese government bonds at near zero yield, and they'd rather do that than risk the vagaries of the international bond market. They also may have their orders from on high, of course. Anyway, this has encouraged hedge funds to exploit the carry trade, where they borrow the low-yielding yen and convert to a high-yielding currency. The expectation, of course, is that any loss on currency conversions is more than matched by the interest differential. Now, occasionally we see a crisis of confidence and the Japanese yen plunges as overexposed hedge funds scramble to cover their positions. But for the past several years, the trend in the cross rate has been broadly down. Some of these sharp moves, I think, can be attributed to short covering on the part of the hedge funds. So we've had a move off the low, just under 76 here, and I'll broaden the chart out in a moment. But I want to show you the tram lines. I'll get to those in just a minute. And of course, trends, which is well established, of course, by this time, do not go on forever. It's a general rule of the markets that major trends change for no apparent reason. And it's only after a lengthy period along the new trend that the reasons, in quotes, becomes obvious to almost everyone. As you know, I let the charts do the talking, and I believe they're telling me that they wish to establish a new uptrend, and this could last for several years. All right, here are the tram lines I've drawn. These are lovely. I've got a prior. This is the first one, by the way, the center one. Lovely prior pivot points here, there, and there. So that's a nice prior pivot point here to establish this as a good tram line. The one underneath, of course, passes through these points here very nicely, and then the third one above passes through these points, and very nicely we've got a prior pivot point there. Okay, I think these tram lines should continue operating for quite a long time. So let's zoom in here and take a closer look, because that's pretty much ancient history. All right, that's a fairly close look. You can see that the move off this low has occurred in possibly three waves. Here's wave one, here's wave two, and we could be in wave three here. We've got a very high momentum, so that's good for a wave three, long and strong. And we're currently coming down to make a wave four, potentially. If that's the case, then I'll expect a nice rally back to make new highs above the 84 level. Now, the one of the factors about Elliott wave is that if we're in a 5 wave sequence, wave 4, which I think we should be putting in roughly here, should not overlap wave 1. So if I can just get the straight line going here, I think you'll find that's about we're just about there, within a few pips. That's allowed. So I don't want the market to go much below current levels for it to qualify for a 4th wave here. All right, let's get rid of that. It's cluttering it up. Okay, now another feature of the of wave 4 is it should be a corrective wave. So let's go to the hourly chart. Here we go, and I need to go back to the peak at 84. There we are. Let's give that a bit more room. Okay, I think I can draw some tram lines actually going down. Let's grab that tool there. Look at this. Yes, 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 yes. Look at those lovely touch points. I think that's pretty good there. Lovely touch points here, little overshoot there. Good, good, and good. Let's now draw the parallel. See if we can find some down here. Ah, yes, that's pretty good, isn't it? We've got a lovely touch point there, slight overshoot, good point there. And in the last few days, we've had a move down towards the lower tram line, but it looks like it's met that pretty well. It's not going to make it. In fact, in the last hour or so, the market has rallied quite nicely. Okay, let's take a look at the character of this decline off the 84 level. If that's wave 3 and if this is wave 4, then you see how overlapping the waves are. There's no really clear cut down thrust, which you would expect if it was a bear market. The waves are overlapping quite nicely, aren't they? So that again, the character suggests to me that it is a corrective phase, ready for a resumption of the rally. And of course, if we can break this tram line here, then that will, I think, be pretty solid proof that that we've got the rally continuing. Let's do this. I wish to go back now to the daily chart because I want to put the Fibonacci. There we are. I want to put the Fibonacci tool on this correction. So let's start off with this low here, up to the 84 high. There we go. And sure enough, the market has come down to the 50% level right there. That's very pretty, isn't it? That should be very, very solid support at the 50% level. And there again, there's my wave 1, which is lying just below the 50% level. So if this holds, then I think we've got a pretty clear 1, 2, 3, 4, and I'd be looking for a new high in the next few weeks above 84. The other little bit of a clue, if I can scoot up here, this lies on the tram line, so that's the previous low. That's made a new low, but look at the momentum. The momentum has not made a new low below that level. So that is a potential positive momentum divergence, another very strong indication that the selling is drying up, buying is coming in, and the support has a very good chance of holding. Now, how to trade this? Because as I say, I believe this is a very long-term trade. I would like to give any position I take pretty wide stops, much wider than I would use in my swing trading. So what I'm suggesting, and I'm doing myself, I'm going to be taking small positions. Let's say 1/10 of your total intended position. Let's say you've allocated a certain amount of your account to building up positions in this vehicle. Then I would say building up positions in this area here, perhaps 1/10 or perhaps even slightly more than 1/10, maybe 1/8 of your account just to start with, and stops can be quite wide down here somewhere, perhaps even below here, because you don't want to be stopped out too soon of a promising position. And as the market moves up, another small sliver of your position could be added. And if the market moves above this 84 level, you've got a very nice base here. And then beyond that point, I would look for dips to add. Here's a dip here. We're starting off our positions here. That would be another place, say around there. And then if the market moves above this 84 level and then falls back down, something like that, you would look to add on dips. So over the next few weeks and months, I would be doing this operation, adding on dips. And I would be putting my protective stops at each individual level. I wouldn't put one stop for the whole position, because nothing more annoying, as you know, than being stopped out of a promising position too early. You want to be cascading the stops down in the marketplace. All right, so that's my trade candidate for 2012. I hope you've enjoyed that, and good luck in your trading.